Hello to all traders. Hello, everyone. And thank you for joining me for this free live webinar on important calculations in Forex trading. Just before I begin, I just want to let you know that we're going through kind of like a basic understanding of the most important calculations in daily trading and in trading in general, actually, ones that I've actually come across time and time again. We get asked many questions over the years about how to calculate certain things. So, excuse me, without further ado, just want to, as I say, give you a brief introduction and just take a look at the things we will be looking at today. So these are the calculations, as I said, just going back to basics, not going too advanced on a few things, because there's a few traders that come to me and say, they want to understand basic calculations and how things are going. And usually most of the time, because it can go back to the beginning of the calculations, they are a little bit shy or afraid to ask these questions. So we'll get straight into it now. So we're going to look at just a few things: margin, equity, free margin, margin level, calculating profit and loss, leverage, pick values, swaps, and pending orders. So this is all tied in to their own calculations. And obviously some will actually delve into other ones as well, such as leverage actually goes into a few of these as well. So let's just go to the first slide. So margin. So margin requirement is based on the volume, leverage, and the instrument traded. So each Forex pair, for example, we're going to get a different margin requirement based on what we're trading on. So I've given us a basic example here. So we've opened a one lot euro dollar trade with 1 to 500 leverage. Now, the way we calculate the margin is the price. I did this presentation, obviously, I started doing this PowerPoint a few days ago. So obviously the price has changed a little bit from the 112.86, but we'll use that as an example. We times by volume. Now the volume based on the lots is in units. So let's just take, for example, we've got 100,000 notional units for one lot. For a micro lot, it's 10,000. Sorry, a mini lot is 10,000 and micro lot is 1,000. We'll look on the MT4 platform though shortly to give more examples. And we divide it by a leverage. My demo account that I'm going to show you in a minute is based on the 500 leverage. So it'll just be a bit easier to understand. So based on that, we've got the price times the notional value divided by 500, which is the leverage. And this will be the margin requirement based on this price of one lot of euro dollar. So if we're trading with smaller lot size, it means that the margin requirement will be also smaller. So like I said, if we're trading with a mini lot, which is 0.10 or up to 0.99 actually, we'll be going for 10,000 times the price and divide by the leverage, so it will be even smaller. So let's just bring that up on my MetaTrader 4 demo account with Orbex. So I've got just a nice balance at the moment, 5,668. I've been trading a few trades in the last week. I started off with $10. No, I'm joking. I'm not. I started off with $5,000 and I've just built up a little bit of a profit based on a few trades that I've done. So if we take the last example that we had, so we had euro dollar. So now it's gone up to 113.92. So just bring this over here. So we want a one lot trade, and so that's 100,000 notional units, and we're going to open that. So I've got a margin of 226.22. Now, if we just take the calculator out, just to show you, so 1.1311 times 100,000 and then divided by 500 leverage. So 226.22. If for whatever reason you want to use a lower leverage, we'll get into leverages a little bit more, but obviously we're going to cancel that again. So 1.13110 times by 100,000 and then divided by, let's say, 100. If you want a 1 to 100 leverage, then obviously the margin requirement will be a little bit more. So it'll be 113.1. And again, this applies for not just euro dollar, but for all of these trades as well. If you want to, let's just close that. We want to open a smaller amount. So let's say 50. We buy that. So as you can see here, the margin requirement is the price times by 10,000 this time, because 50,000 this time, because it's 0.50 and divided by 500. So let's just bring that up so it's a lot more clearer. 1.1317. So times 50,000 and then divided by 500. So 113 0.11, and we've rounded it up to 12 here. So you'll see that if this decimal is above 5, then it will be rounded up most of the time. So that's a brief look on the margin at the moment. But, you know, the margin itself is determined by the quote price most of the time, which we'll look at shortly. But I just want to touch upon the fact that if we are opening, let's say, for example, let's just take a random one, Euro or Aussie, let's say, and we want to open this 0.5 lots, then again, the margin is 113.2 because we've got, let's just check. So we've got, for example, 1.58412 and then times the 50,000 and then divided by 500. Now you're probably looking to see, okay, on this time around, we've got a different number. This is because we're not using my demo account is dollar based. So everything is quoted in dollars. So now we have to get this back into dollars. And the way to do that is we divide this by the exchange rate of the Aussie dollar Forex pair. So basically what I'm going to do now is get this 113.12. So if you remember this number 158, so 113.12 and then divide that by 158. So this is approximately the, that's gone off. So if you look at the Aussie dollar pair, it's approximately the same value. So this is because my base currency is dollar for the account, and we have to calculate this in dollars for the margin. So this is why it has actually gone with the Aussie dollar exchange rate at the moment. And we can do it with many other trades as well. Let's just do, for argument's sake, dollar CAD. It's quite close to the Aussie dollar. So we've got $100 margin here, 50,000 notional units. So we go to 1.27226, and then we're going to times 50,000 divided by 500, and then we're going to 127, and then you can see already 1.27. We just have to divide that by the 100, and then that's going to get to 127, which is the dollar CAD amount. So just keep in mind that if there is a confusion about margin, depending on your base currency, to keep it simple, Orbex only offers dollar-based currency at the moment for its MT4 accounts, especially demos. So just keep in mind that for now. So with that being said, I'm going to leave this trade open because I want to start looking at profit and loss as well, and also other things that are going on. So just go back to the presentation. So equity. So equity is the basic calculation of your balance plus or minus your open P&L. So therefore equity equates to your real life funds in your trading accounts. Once all the trades are closed, your equity will be the same as your balance. So with that being said, as you can see here, the balance plus or minus your open P&L. In fact, mine, unfortunately, at the moment is minus 1258. So this minus 1258 will be the equity, and the equity is taken from what you have available for trading. So if we were to open a lot more trades here, say multiple trades of one lot, and our margin level and our equity, sorry, went below what we could open for the margin, then we could not open any more trades. So just keep in mind for that your equity is it's basically your main balance, but because if you've got open trades, then it becomes your priority balance that you have to keep a lookout for in case you don't cross that threshold. Okay, and so let's just continue on. So free margin as well. Let's just free margin and margin level. So this is these two figures here. So these are important to keep an eye out for, because if your margin level drops to 100%, this gray bar here will turn red on your MT4 to give you a warning that your margin level is low. It means that your trades that you have open have actually delved into a little bit of a loss, or probably a major loss. I'm just trying to be kind about it, but it's dropped into quite a loss. And in doing so, it has actually affected your margin level. So 100% is your margin call, and then below that, the trades, if it falls further, your trades will start getting stopped out, and nobody wants to see that, obviously. So with that being said, equity minus margin, minus your margin, is your free margin. So this is the amount available to open more trades. If there is not enough funds in the account to open more trades, the message "not enough money" will appear. So this is why you will get this message if you do get it. It was because you don't have enough free margin. And margin level is your equity divided by your margin times 100 to get the margin level. So like I said, margin calls 100% and stop out is 20% on the account. So let's just take a look at how that applies. So what I'll do here, I'll just freeze frame this so it's a little bit easier to see. And we'll get our calculator out just to show what's going on. So like I said before, equity minus margin is your free margin. So equity at the moment is 5631.92 minus 100 is 5531.92. And then if you get your equity and divide by the margin and then times 100, same kind of equation. So you equity divided by free margin, and that will get your margin level. So 5631. I think I just did a small. So 5631.92 divided by 100, and then times 100. So 5631.92. So this is just basically a percentage equation to let you know that if it does drop, if your margin level does drop to 100%, this line will turn red. Can probably just delete this now. This line will turn red here, and then 20% your trades will start to stop out. It is important, however, that your trades, if you have many of them open, they don't have to be in a negative to be stopped out. If for some reason the market goes swiftly in the wrong direction of your trades, be it if you've got dollar CAD open, pound Kiwi, euro dollar, if it does go in the wrong direction of your trades, in your margin level drops to 10%, let's say, most of your trades will be stopped out, even if they are in a positive or negative. So just remember, keep that in mind, because I've had a few traders in the past asking why their trades did get stopped out and their positions were in a profit. And the easy answer to that is because your bigger trades that you had open that had such a deficit, such a loss, they actually caused the whole account to stop out, meaning that every trade was stopped out, even though we did have some positives in there as well. So just something to keep in mind, because I've been asked that question quite a few times as well. The next slide, just to go into pips and points. So pips and points, the pip is quoted as the pips and points. So the pip is quoted as the fourth digit, and the point is the fifth digit in most Forex pairs. In Japanese yen pairs, it's the second and third. So here's just a slight example. So euro dollar, so we've got 1, 2, 3, 4 after the decimal point. So this is the pip. So we've got 5.9 pips going on here. And in point value, it's 59 pips, basically. And with dollar yen, because we've only got 3 digits after the decimal point, the pip value is the second digit after the decimal point. So here we've got 3.1 pips, or we've got 31 points, depending on how you're calculating and what you prefer. So this is what it is in the market. And again, we'll take a look at the MT4 platform to see here. So as you can see, euro dollar 1.13117. So this is the one, well, it's flat, obviously moving quite significantly, but this is 2.1 pips, for example, at the moment. If we look on the yen pair, this is 0.6 pips at the moment. You can actually make it more bigger, you know, pips and base points, etc. So you could say at the moment this is 121 pips or 120, and you know 3,120 pips as well. So you can do it based on how you want to calculate. But you know, to keep things simple, the fourth digit is the pip value and the last digit is the point. So 19 points or 1.9 pips. And if we just take a look at the pip values as well. So this is how we calculate for the major currencies and even the minor currencies as well. So the dollar quote currency. So basically, if the Forex pair you're trading on ends in dollar, then it's a standard $10 a pip move. So this is for euro dollar, British pound dollar, and Australian Aussie versus American dollar. So it's $10 a pip round. So it's a very easy calculation. When we get down to other currencies, it gets a little bit more tricky, but if you keep these in mind, these are always standard and fixed. So Swiss franc, basically the one pip value is 10 divided by the dollar Swiss franc rate. So let's just quickly take a look at that. So the dollar Swiss franc at the moment is 0.9253. We'll get the trusty calculator again. So 0.92, 10 divided by 0.92532. So each pip value at the moment is approximately, because we are moving a little bit up and down, it's approximately $10.80. So that's one, for one lot, that's the pip value for Swiss franc. And let's just go back to the presentation. And again, for yen, we've got 1,000 divided by dollar Swiss franc rate. So again, let's go back to, so 115.60, and that's 10,000 divided by 115.60. So it's approximately $8.65 per pip. So you can see already that the dollar Swiss pip value is higher than the euro dollar, the American dollar pip value, because that's $10 fixed, and it's higher than the yen dollar pip value because that's 8.65. So you get an idea and an understanding of what are bigger rates and what are bigger pip values as well. The sterling, for example, 10 times the pound dollar rate. So you know this is going to be a big one because the pound dollar rate is 135. Obviously 10 times 135 is 13.35, but let's just take a look just to show you. 10 times 1.35, 13.5. So already you can see what currency pairs are being affected quite vastly if you do have these trades open. So if you were to open a one lot of pound dollar, you'd probably know that it would cost a little bit more on the margin than you would say Aussie against the dollar or the dollar Japanese yen. So it's just be careful to keep in mind all of these rates, because they make use of the trades that you're opening and the profit and loss as well, which we'll come to look at next. So calculating P&L based on the instrument traded, volume and pip value. These three are very, very vital because it actually mixes up, excuse me, the calculation of what we're looking at here. So taking a simple example at the moment to start off. So euro dollar, we know it's $10 a pip fixed because the quote currency is dollar. So euro dollar is $10 a pip. So if we've had a trade and we've realized 5.3 pip profit on a two lot trade, so we've got 5.3 pips times $10, which is the pip value, times two lots, so that's $106 profit. So let's go into the well, I've had this dollar CAD trade open, so this is probably going to be a good example because I've given a dollar CAD example here as well. So dollar CAD, what we've seen from this screen is that the pip value is 10 divided by the dollar CAD rate. So again, we've done an approximation. So it's approximately $8 a pip because it's 10 divided by the dollar CAD rate, which is 1.20. Is it 1.27? It is 1.27. So let's just take a nice look at this. We'll freeze it so it's a bit easier to see. And we'll get the trusty calculator out. It hasn't failed us so far, so hopefully it won't this time. So we've got, so first of all, we know we're on a minus because we've opened, I'll just simplify this. We've opened a buy position and the opening price is currently above the price that we've got the trade live at. So we automatically know that it's in a minus because if we had a sell position and this price was lower than the open price, then naturally it would be a profitable trade. So let's just take a quick look. So we've got 1.27226 minus 1.27197. So the difference is 2.9 pips. Like I said before, this is the fourth digit. So we've got 2 pips and this is the point. So 2.9 pips. So that's your P&L at the moment. So well, we're losing. So 2.9 pips deficit. So we just have to remember that. And what we're going to do now is multiply by the lot amounts. That's 0.50, which equals 1.45. And then we're going for the approximate rate. So if we just remember 1.45, which I just need to write down just in case, because we're doing a few things here. 145. So now what I've got here is I'm going to calculate what the exact pip value is, 127,221. So 7.86. So 7.86 multiplied by 145. And then we've got an approximation of our negative P&L, 1140 and 1139. So again, we've rounded it up. However, there is a way of getting the exact pip amount. If you've got an open and closed trade, the exact way to get the exact pip amount is put in the P&L, and then we have to divide by the amount of pips, which I believe was 3.9, if my memory serves me well, and then divide that by 0.50. It wasn't 3.9. Apologies. I just took a wild guess there because I've done a few calculations in my head. So 1 second, minus 1.27197, 2.9. I knew I was close. So we've got 11.40 divided by 2.9, and then divide that by the open P&L. So that's the exact pip amount down to a T that the trade was opened at the time. So it's just a little calculation for you to understand, for you to take comfort in, basically, to know that you knew the exact pip amount that you have your P&L based on the dollar CAD instruction at the moment. I've got another example. I want to give you a live example. I've got another example here. So a dollar yen trade. So we know the pip value for this equation is 1,000 divided by the dollar Japanese yen rate. So $8.8 approximately, because we're just doing an approximation at the moment. We did a 5.3 pip profit times 8.8, which is the pip value, and times 2 lots. So we got this P&L. On the example I've given, we've got a P&L of 98.8. So this would be what we've closed the trade at now. And we've divided by 5.3 pips, which is $18.50, divided by 2 lots. And then we're given a $9.25 pip value. So based on the price we opened the trade at the time, it's a $9.25 pip value. And this works for every trade. We can just do another one at the moment. I'm in profit as well. So it's a shame to close it, but probably better than not. So we know that these pairs are $10 ending with the dollar quote currency. These are standard fixed $10. So let's go for maybe more of a tricky one. So we'll go for this. So already we're obviously, I'll explain why we're in a deficit at the moment, but if we go to, we'll just again do this. So we'll get the trusty calculator out again. And we've got $10.35. We have to first see what the pip value, what the difference is. So 158,493 minus 1.58464. So 2.9 pips again. That's a nice coincidence. So 2.9 pips. So we are going to do 1035 divided by 2.9 pips and then divided by 0.5, which is the volume. So there you go, 7.13, which is the exact pip value that we opened the trade at. 7.13 for Aussie dollar. And we're going to see now what the pip value equation is for the Aussie. I don't actually have it at the moment, but what that is, it's probably not the greatest example, but pip value is for Aussie dollar. I'll just get it up for you now. bear with me. $7.41. So basically just going back, I'll get back to that in a second, just going back to the examples I gave. So the quote currency relies heavily on the P&L and obviously calculating the, excuse me, got a technical thing. Yeah, and calculating the actual margin as well. So with that being said, this is how you can check all the pip values and points. Just remember that it is if Orbex and many other brokers give it a fifth digit on their most of their Forex pairs, just to make it more transparent. So instead of this just flickering up and down to 6 and 7 and 8, we're giving another extra digit to break it down easier and make sure that we are looking at the right, the right way as we go through into everything else as well. So just let you taking a moment to see what we're looking at here before I go on to the next slide. So as we go into the next slide then, so leverage calculation. Now, leverage plays a key role in a lot of the calculations. Like I said before, when we're doing margin, when we are opening and closing trades, leverage is very, very key. If we are, let's say, wanting to trade, really push our limits and wanting to start trading on 1 to 50 leverage, let's say. So if we open one lot on euro dollar, so 1.13088 times 100,000 notional value, and then divide that by 50, then obviously the margin is increasing quite significantly there, rather than 1 to 500 leverage. But leverage, we'll go into leverage on a different webinar, a little bit more in depth, but it is a double-edged sword. The higher the leverage, the higher the risk on the market bouncing in the wrong favor. And whereas if it goes in the right favor, leverage requirements can be quite accommodative, but if it's the other way around, then it can actually lose quite a bit as well. So with that being said, let's just take a quick look on the margin requirement. Now I need to keep these trades open. I keep closing them accidentally. Let's just take a let's just open a one lot, and we'll show what's happening here. So with that being said, currently my leverage is 1 to 500 and my margin level is 2,486. Now, just another calculation I want to show you, that if we want to lower the leverage on your account, because maybe you want to rewrite your portfolio, maybe you want to do a different trading strategy for whatever reason, increasing a leverage will not really affect your open positions, as your margin level will not be lowered, which is quite important. However, decreasing leverage will have an impact on open trades if you have any, and could also change your approach to future trades. So the calculation, basically, I've done a quick calculation because I've got a 1 to 500 leverage. If it's basically the old leverage divided by the new leverage gives you the difference, which is 5 in this case. And this indicates how many times smaller the leverage will become. You then divide this, the current margin level percentage by 5, and this will give you your updated margin level percentage. So if I wanted to lower my leverage to 1 to 100, and I had this open trade, I would have to get 2,488 and then divide by 5, which is the difference. So my margin level would drop to 497. And unfortunately, that's quite close to 100. It's not very far away. You probably think that 400% is a lot, but with the market, how the market can move quite significantly, it's not really that much. So With that being said, if you are thinking to lower a leverage, if you have a high leverage and you have open positions, just be careful where you move it to. If we go from, let's say, 500 in my case, divided by, let's say, if I go down to 300, which isn't too much, it's got 1.66. So again, we go 2484, which is my approximate margin level at the moment. Percentage, and I'll drop down to 1496, which isn't too bad. It's quite a decent margin level, not too close. But again, if you are looking to lower your leverage, even with closed trades, with no open trades, then just be careful that you will be looking at possibly hitting that margin level and possibly getting that 100%, and this line will turn red on the trading screen as well. So another thing I just want to touch upon, I touched upon it in the last webinar, but a few people that I spoke to, a few traders that I spoke to last week wanted to know the differences between the bid and the ask price. I'll just run through it quickly because it can be very tricky. What I'm going to do, I'm going to go to a minute chart, so it's a little bit easier to see, and I'll zoom in a little bit. So what we've got here is, because I've opened a buy position, the buy position opens at the ask price and closes at the bid price. The bid price being this line that you're seeing here, which is constantly on the chart. The ask price has to be selected. So if you go to right click and properties, show ask line and open, this is the ask line. So this is why we are currently in a negative, because this ask line has to go above my open line, which is 1.1312. Once it does that, then I'll be in a profit. And the difference between the bid and the ask is the spread. So that's always important to keep in an eye on as well. Excuse me. So with that being said, let's close this trade. And now let's open a sell position. So now that I'm going to open a sell position, it should open at this ask line roughly at 113.11. So let's just try that. So I'm going to open a smaller trade because I'm paying the spread all the time and I'm losing some of my demo funds. So let's see. So 113.099. So it's just a little bit, let's just see where that is. So basically what I'm going to do now is open at the ask line. Sorry, my mistake. It's open at the bid line and closing at the ask for a sell. For a buy, it's opening at the ask price and closing at the bid. So now my sell position has to, because it's a sell position, this ask line, it has to go below my open line here, which is the green dashed line, for me to make any profit. And that's just the way the market works. It opens at for sell position, opens at the bid and closes at the ask, and the buy position is vice versa. So as you can see here, the ask line is not always appearing. You have to actually select it. So that's why it can be a little bit tricky for some traders to remember that when you are opening a trade, buy or sell, then just remember that if it's a sell position like we've got live at the moment, I'm in a deficit of 1.2 because currently that's the space between the bid and the ask. It's 1.3 pips approximately. And this is why we are not getting anywhere at the moment. So just a little thing to keep in mind, because I do get asked quite often about that. So we'll see how that goes in. So next on, I'll just move swiftly on, and we're looking at swaps now. Now I haven't actually got any live swaps to show you on the MT4, but I just want to go through a slight calculation. So a swap calculation consists of 4 nominations. So we've got calculation, this is per one lot. We can go lower, but I'm just doing per one lot at the moment. Then we've got pip value of the Forex pair. So let's just take, for example, euro dollar, it'll be a $10 pip value. So per one lot. Volume of trade, again, this can be whatever volume you want to open. We'll take, for example, a one lot trade, so it's a lot more simple. And then the pip long and short. So this is the MT4 specifications. And then we've got number of days. So we've got pip value per lot, volume, pip long or short, and number of days open. Just a quick reminder that swaps are only applied to active market orders, not pending orders. So if you have pending orders pending for a few days, these swaps will not be applied on them. So let's just take, for example, a quick example. So we've got euro dollar here. If you right click here and go to specifications, you'll see the specifications of swaps here. So swap long and swap short, bearing in mind this is points. So what does that mean? This means that this decimal point here will go at the front. So this will be, when you're doing the calculation, it will be 0.5222, and this will be 0.0857 because it's in points. So let's just take a quick calculation. Apologies that I haven't got any swap calculations to show you live at the moment, but we can do one as an example. So as I said, we've got pip value. So we've got a euro dollar trade, which is $10 a pip. And we've opened one lot, so times one. And then we're timesing the number of days open. So let's just say we open it for 3 days. And now we're going to multiply that by, we've got a short position open here. So it'll be 0.0857. So for 3 days, we'll be charged $2.5 in swaps for overnight fees on the MT4 on your open trade, and this can be applied with any currency. You just have to see the specifications. So again, this will be 0.77. This will be 0.5138. And just to keep in mind when you're doing Forex calculations, it's just it's very good to know, because you might wake up one morning and think, oh, my swap has, why have I got like swaps of $2 or $3? And it's because that swap charges can actually change at any point in time based on what the broker is giving, and on top of that, based on the pip value and what you are looking at as well. So that's why we are seeing so many different swaps for different pip values, but it's just to basically keep an eye on the specifications, and that'll give you a good hint. So just to recap, so it's the pips per lot. So that's $10 for euro dollar, volume of trade times number of days it's open, and then multiply this in points. As I said, the decimal point moves to the front here because it's in points, it's not in pips. And then that gives you the rough, no, not the rough, it'll give you an exact swap value on that as well. So just a few things to keep in mind there as well. As you can see, just going back to my live trade, my ask price has dipped below, because I have a sell position, dipped below my open. As you can see, oh no, it's okay. I spoke too soon. Now we've gone back up. So now I'm in a minus again, but just earlier, just a couple of moments ago, it was in a positive because the ask line did dip below my open price. As you can see here, it's moving lower now. So I'm in a profit. So it's just something to keep in mind that when I open a sell position, opens at the bid and closes at the ask. And for a buy position, it's the other way around. It opens at the ask and closes at the bid. So this is why it's nice to keep the ask price open, just so that you are fully aware of where your trade is going. So as we go into the next slide, so orders, I just want to look at two types of orders, which are pending orders and market orders. So market orders we've seen live. I've opened a trade for you, and we've seen that the market order has activated initially. Pending orders, on the other hand, are basically limit and stops, and these are the ones. So buy stop, sell stop, buy limit, and sell limit. And what is the difference? We'll go through a couple of live examples in a second. However, just want to show you what the differences are. So a stop basically means that we are expecting the price to break through and then keep going. So for a buy stop, the pending order is made above the market order, sorry, the market price. Once the market price is broken, then we move higher. So I just put this blue line in just to denominate that this is the bid line when we open the price. Sorry, the green line is the bid line, and then this is the pending order. So once the bid line is broken, the pending order is placed above the bid line because it's a buy stop, and then the price keeps going. Conversely, it would be the same if it was the other way around. So sell stop, the price, the pending order is made below the market price, and the price is expected to hit and keep going. Again, we'll look on the MT4 platform in a second. I just want to go through just a couple more examples. And the limit, this is where it gets a little bit confusing because the order is placed below the price line and then it's expected to bounce and retrace. So basically this blue line here is the price line. We're expected to move through. We're expecting that the price will hit a certain amount. So let's just say, for argument's sake, this is euro dollar trade. This is the 113 handle. We expect it to hit the 113. The pending order will be activated and open, and then we're expecting the price to move higher. So the limits are placed opposite each other. So for a buy, it's placed below the bid line, and for the sell, it's placed above. So how does that work on the MT4 platform? Now let's just take a quick look. So I'm not getting anywhere with this trade, unfortunately, so I'm going to close it. We don't really mind too much that we are in a deficit. So I'm just going to take the ask line off just so it's a little bit less information on the chart. So for a buy stop, now this is the bid line. Now I'm thinking that this is a good example. We've got a little bit of a double top here, let's say. And I'm thinking, okay, if the price breaks this 113.13, I expect the price to keep on pushing higher. So I'm going to put a buy stop in. So how I'm going to do that? I'm going to go to here. I'm going to go to pending order. I'm going to put my buy stop, and then we're going to go to 1.1313 and place it. Okay, it's telling me invalid stop loss and take profit. Now this is very important because this message here, the open price you set must differ from the market price by at least 5 points. So what it's telling me is that it's too close to the, because I'm opening a buy, it's too close to the ask price. I'll put the ask price back on. As you can see, it's too close to the ask price, so I need to move it a little bit further away. So let's try a little bit higher and give ourselves a little bit more breathing room. So buy stop, so 1.13, and we have 15, and it's taking it. It's very close to the market being hit, but it's taking it because it's more than 5 points away from the open price. So now what I'm expecting here is for the ask price to hit this, my pending order, and to keep on going. So that is what a buy stop is. Conversely, a sell stop means that I'm expecting the price to move to here, excuse me, and it's going to hit and then keep on pushing lower. So that's why I can put a sell stop in. So this is a basic example. Just remember, buy stops in general have to go above or below the buy or the sell in the market. So for example, sell stop, I'll just put this in as well. So we've got pending order, sell stop, and as we said, it has to be below the market price. If for whatever reason, if you're making a mistake and putting it above, it will never take. So you can do 1.1315 like we just said. Because it's a sell, it won't take. We can even go up to 115, let's say, for argument's sake, which is very, very far away from the market. Invalid stop, invalid, because the sell stop can only go below the market, which is what we're going to do now. So 130.40. Sorry about that. So just went off it. So 1.3040 place. Oh, it's not even letting me do that because it's probably think it's too far away. So let's go a little bit lower. And it's not letting me go. So because the market is moving quite a bit, we are looking away from that. So let's move on to the limits as well. So I just want to just another thing to tell you, when it activates as green on your terminal, it means it's very close to being hit. As you can see here, the market isn't far away. If it goes back to gray, then it means that it is quite far away from being hit. So let's just look at limit orders now. So I'll move all these just so that it's a little bit easier to see. So limit orders, as I said, for a buy limit, it has to be, we're expecting the market to start moving lower. It's going to hit the market, hit the pending order, activate it, and then start moving up. That's the whole point of limits. We think that the word limit means there is a limit to the price, and then it's going to turn around. So let's just show that. So pending order, so buy limit, and we've got 1.13. Let's just do 113 round. So we're expecting the price to move lower. I think I know what I was doing with the sell stop. I was putting 130 instead of 113. So apologies for that. But you get the general idea. So now what we're expecting on this buy limit is the market to move lower, hit and activate, and then start moving higher. Now, a lot of people ask me, why would you put a limit order in? What's the significance? Well, if you see in the market that, so let's run a 5-minute chart, for example, if you see maybe these lows as a support, let me just get hold of this. If you see this as a nice support, so we've got pretty much a hanging man candlestick here. We've got some full body candlesticks here as well. And we've got some little tests here. So you might think, well, I'm looking at this as I think it's going to hit there again and then start moving higher. So that's where the limit order comes in. And actually, if you've got your chart open, like I just did there, you can just drag it down and modify it like that. Instead of opening it and putting in the price again, you just quickly drag it down or drag it up. So this is what a buy limit is, where it's placed below the market, we're hitting a price, and then we're moving higher as well on top of that. Now let's just take a quick look at the opposite direction. So we'll close that. So now we've got a sell limit. So a sell limit, exactly the opposite. We place the limit above the market price. And now I'm thinking, well, I'm thinking it's going to go to roughly about this level. Where we've seen a little bit of resistance, and now we're going to move lower. So I'm going to open my sell limit option and 113.26, and it's open. Just bear in mind that if the market is moving quite frantically and you're trying to put a pending order in, then this message here obviously becomes a little bit irrelevant, because the market cannot see, 5 points is very small significance in the market if the market's moving very quick. So if this, let's just say, if there is a line doing this all the time, it will be a bit difficult to place a pending order due to the market volatility at the time. So just a few things to keep in mind. Another thing to keep in mind there. So getting back to it, I've just deleted everything now, but the basis is for the sell limit. I'm expecting it to hit here, and then we're going to start moving lower. My pending order is going to be activated in the market, and then the market will start moving lower, and then I'll start seeing the profit being realized in that respect. So just as I said, with pending orders in general and market orders, just be careful what you are trading on, so that you're getting the full value of the limits as well. Just another thing, when we are placing pending orders, if you're placing them during rollover times or or times when there is less liquidity in the market, I'll show you a good example here. If we go to the early Asian session, which is during rollover, as you can see here, I'm going to scroll back a little bit. So this is when we have rollover. Obviously, for people in different parts of the world, they're probably awake at this time, but because it's our server rollover time at midnight, we do get some gaps in the market. And if we just zoom in a little bit more, we can see here that the liquidity is very thin here. It basically means that there's not a lot of traders in the market, and then there's not a lot of pricing in the market. And this is why you see very flat minute candles here, gaps in the market, and so on and so forth. As we go into the trading day, into the moving out of the early Asian session and the Australian session, moving into the European session, we see a lot more full body candles, less gaps in the market as well. And obviously, as we get into opening, let's see here, look, 6 in the morning, 7 in the morning, 8 in the morning, we are looking at full body candles, less gaps, and this will be an easier time to put in pending orders and for them to be hit at certain times. If, for example, you put a pending order in and there's less liquidity and gaps in the market, this is just before rollover, then there could be a possibility that the pending order might not have been hit at the correct price. And this is due to slippage. Slippage is something we're going to go on to another time, but just be careful that if there are gaps in the markets or thin liquidity, it will be harder for pending orders to be hit as well. So with that being said, it's just another little market tip that we want to give. Well, I want to give, because I want all our investors and potential investors in the Forex world to know exactly what they're dealing with here. So in closing this presentation, I've come to my last slide. I just want to basically let you know that the next webinar will be on Monday, and this is where I take you through what trading stocks CFDs. And this is important because when we're trading stocks on exchanges, trading stock CFDs is a little bit, well, a lot different than trading stocks on exchanges. Obviously, a stock such as let's say Tesla or BMW, whatever manufacturer or company, looking at McDonald's, Coca-Cola, etc. If their shares go up, then naturally on an exchange, the investor makes a profit, and if they go down, it's the other way around. However, trading stock CFDs, like we've seen on the MT4 platform, if you are buying or selling, there are opportunities in both directions. I'll just give you a brief look. Orbex does offer a vast amount of American and European stocks to look at, and lots of opportunities there as well. We've seen recently that Facebook, for example, they did have one of their worst days ever when they missed subscriber numbers. And if we just take this back to a daily chart, as you can see here, we're hitting yearly lows on these prices. This would be a good opportunity during earnings season, when earnings season is upon us. If there was a slight knowledge in the market that Facebook was going to miss its targets, then a sell position obviously would be very, very advantageous here. And then we see such a big drop in the market, and then a position can be closed after that. And then obviously, with this being said, over $100 move in the market, depending on your lot size as well, would mean that it'd be a significant profit. So there are opportunities for buying and selling CFDs and stock CFDs. Because we offer so many stocks, I don't want our traders or investors to miss out on any potential profits, even trading stocks. It's not all about Forex and commodities such as gold and oil as well. It's also to do with shares as well. So just do a quick recap on what we've just gone through now. So just remember, the margin, volume, leverage, and the instrument ties in significantly with what we're looking at when calculating the margin, and obviously the lot size and leverage as well. Equity, simple calculation, balance, divide, sorry, your equity is your balance plus or minus your open P&L. Free margin, equity minus margin, and margin level is equity divided by the margin times 100. It's only times by 100, so it's given as a percentage. That's the main reason. Pips and points, just to remember that the fourth digit on most Forex pairs is the pip, and the fifth digit is the point. So that's 59 points or 5.9 pips. And again, with yen pairs in particular, it's the second digit after the decimal point. So we've got 31 pips here, or 3.1 pips. Pip values as well. You can take these calculations down This video will be recorded and posted on our social media channels. However, as you can see here, dollar quote currencies, it's very important to know that it's $10 a pip round, no matter what. And then the reason why we get some fluctuations in the pip values for the other pairs is because it depends on the actual rates that we have these calculations. So even the Danish kroner, it's 10 divided by the Danish kroner rate at the time. South Africans are the same thing. And some are multiplied, some are divided, depending on the strength of the currency as well. Calculating P&L, as I said, we're looking at the pip amount difference on the trade, how many pips you've earned or how many pips you've lost. In these examples, I've done 5.3 pips around, and then based on the pip value as well. And then we're looking at the other thing, and we're looking at the volume amount as well. So in this case, I've done 2 lots here. So that's just to keep in mind. And as I said, to get the exact pip value is very important for a lot of traders, because, you know, we've had a lot of questions saying, I want the exact pip value of when my trade was open. Well, here it is. You take the difference of your open P&L, the profit and loss, how many pips you've earned, and then divide that by the P&L that you've had, and then divide that by the lot amount as well. And that's how we and then lowering leverage. This is just a calculation that I've come across a few times over the years, where people want to ask, you know, if I lower my leverage because I don't like the 1 to 500, I like 1 to 100, can I get any more than any less, and what will happen to my margin level? Then this is what will happen. We lower it, we take the difference, which is 5 times the amount in this case, and then get your current margin level and divide it by the amount that the difference is, and that will be your updated margin level. So it would be very detrimental. I'm just being asked what the next subject is on the webinar, and it will be just the headline: trading stocks, CFDs. Just to remind you. And as we go, swaps as well, as I said before, swap calculation per 1 lot, or you can even do less than 1 lot. It's the pip value per lot. So for example, if you were taking out a 0.1 lot trade on euro dollar, then the pip value will be 0.10 cents. So it will be basically based on the volume that you're taking out. So that's the pip value, volume of the trade. So as I said, 0.1. Number of days and pips long and short on the MT